Welcome back, expert investors. Ready for a deep dive, and I mean really deep. We're talking ETFs, but not just the basics. We're going full-on expert level here. Today, we're dissecting ETF manipulation using the whole GameStop saga as our case study. That whole thing really got people thinking about ETFs differently.
Yeah, GameStop really flipped the script, didn't it? Suddenly, ETFs weren't just simple, predictable tools anymore. It exposed how the mechanics of ETFs, like the creation and redemption processes, could be, well, let's just say utilized, especially when you have a stock capturing the attention of everyone.
Exactly. And that's what we're diving into today. We're going beyond the surface, beyond those sensational headlines, to understand the mechanics that could be used to, well, tip the scales a little, shall we say. So for our expert listeners, and we know you're out there living and breathing the market every day, let's break this down. We've all seen what went down with GameStop, and we know what ETFs are, basically baskets of stocks, right? But what's the connection? How did these two things intertwine in a way that even allows for manipulation?
Well, it all hinges on a key player in this whole ETF ecosystem, and that's the authorized participants, or APs. Think of them as the gatekeepers, the ones who actually control the supply of ETF shares.
Okay, I'm with you.
Now, these APs, they don't just buy and sell ETF shares on the open market like the rest of us. They have this unique ability to create new ETF shares and redeem existing ones. And they do this by working directly with the ETF provider, exchanging a basket of the underlying securities for ETF shares, you see.
So it's like a direct pipeline between the ETF and the underlying stocks, and these APs, they control the flow.
Exactly. Now imagine an ETF that holds GameStop among its assets. If an AP needs to create more ETF shares because, let's say, demand suddenly spikes, they have to go out and get those underlying securities, including GameStop, to deliver to the ETF provider.
So they're obligated to buy GameStop stock to support the creation of those new ETF shares. I see where you're going with this.
It's all connected, isn't it? And this buying pressure from the APs, especially if it's, well, coordinated and strategic, can actually inflate the price of GameStop. It's not natural market demand. It's like a side effect of this ETF creation process being used for, let's just say, another purpose.
And on the flip side, if they're redeeming shares, they're suddenly offloading GameStop stock, which could drive the price down. It's a two-way street where these APs can really influence things.
Precisely. Now, to be fair, this creation and redemption process, it's not inherently bad, not at all. It's actually designed to do something very important, keeping the ETF's price in line with the value of the assets it holds, a concept we call arbitrage. But this mechanism, as with many things in the market, can be, shall we say, leveraged when you have these big players who decide to play a different game.
And that's what makes this conversation so important for our expert listeners, right?
Yeah.
You have to understand this dynamic to recognize when an ETF is, well, more than just an ETF.
Exactly. And to truly understand the scale of what's possible, we need to look at specific ETFs and how exposed they are to something like GameStop. That's where you start to see the real red flags pop up.
So let's get into the specifics. Let's talk about these ETFs that have exposure to GameStop and how their unique characteristics might make them vulnerable to manipulation. What about the SPDR S&P RETL ETF, ticker symbol XRT? What's the story there?
Right, XRT. Well, a couple of things make it interesting. The biggest one is its equal weight strategy. See, unlike most ETFs out there that weight companies based on their market cap, XRT, it gives every stock in its portfolio the same weight. So GameStop, even though it's not a giant compared to some of those other retail behemoths, it carries a much bigger punch in XRT.
So GameStop's influence on XRT's price movements is bigger than it would be in a typical market cap weighted ETF. Okay,
Yeah.
interesting.
And here's where it gets really interesting. To keep those equal weightings in check, XRT, it has to rebalance frequently. And when I say frequently, I mean frequently. So if GameStop goes up, they might need to sell some shares to maintain that balance, and if it drops, they might have to buy more. And this creates a sort of rhythm, a predictable pattern.
A pattern that someone, let's say, motivated could exploit.
You got it. Let's say there's a big player out there, right? They know that XRT is due for a rebalance, and they think that XRT is going to have to buy more GameStop. Well, they could start buying up GameStop shares beforehand, driving the price up. Then when XRT has to buy, they're forced to buy at an even higher price, which pushes the price up even further. It's like this self-fulfilling thing.
It's like those old stories about oracles and prophecies, but instead of prophecies, we have, like, algorithms and ETFs.
Yeah, something like that. And then there's this other layer to it, which makes things even more interesting. XRT, it has a bit of a history of being a target for those looking to short GameStop. See, shorting a stock directly, it's risky. If the price goes up, your losses can be almost unlimited. But when you short an ETF like XRT that holds GameStop, well, it's a way to make that bet more indirectly, a little more covertly.
So you could have a situation where someone's shorting XRT, betting against GameStop, while simultaneously trying to drive the price up using those tactics we just talked about. Talk about mixed messages.
That's the thing about the market. It's complex with different players and motivations. It's a tangled web.
That it is. Okay, so we've got XRT, an equal weight ETF that might be vulnerable during its rebalancing periods. What about some of the bigger fish?
Okay, so let's talk about two ETFs, real heavy hitters. VD, the Vanguard Small Cap ETF, and then there's IWM, the iShares Russell 2000 ETF.
These are huge, like giants in the ETF world. I mean, VB with its massive asset base. It's the go-to for investors looking for exposure to, well, small cap stocks. And IWM, that's all about trading volume. Traders love it for its liquidity. But how do these titans become tools for manipulation?
Well, ironically, their size, their very appeal, is also their weakness. Let's start with VB. We're talking billions of dollars in assets. So even small arbitrage opportunities involving something like GameStop can result in a ton of trading, you see. When APs see a price difference between the ETF and its underlying basket, they jump in to capitalize. And those trades, they've got to be big, given how much money they're working with.
So even a tiny price difference, when you're talking about that kind of volume, it creates ripples, especially with a stock like GameStop.
It's all connected. Now, with IWM, you have this whole other dynamic. Its claim to fame is liquidity. I mean, this thing is a beast. And then you have its options market, which attracts all kinds of players. And while those players, they might not be targeting GameStop directly, their actions, they can have an impact.
It's like a ripple effect. Let's say someone makes a big trade in IWM, maybe hedging their options positions or rebalancing a massive portfolio. That can cascade down to the individual stocks held by IWM,
Yep.
right? Including GameStop. Suddenly, you have these price movements that seem to come out of nowhere, nothing to do with any news or events specifically about GameStop.
Precisely. And that's what makes this so fascinating yet difficult to grasp sometimes. You have all of these interconnected events happening simultaneously. Now let's talk about a slightly different kind of ETF. This one's a little more exotic, a little riskier. Leveraged ETFs.
Hmm.
Specifically, RETL, the Direction Daily Retail Bull 3X Shares ETF.
Leveraged ETFs, yeah. We talked about those a bit earlier. But for those who might need a refresher, remind us again how they work and why they're relevant here in our discussion about manipulation.
So leveraged ETFs like RETL, their whole game is to amplify the daily returns of an index. So in RETL's case, it's 3 times the daily performance of the retail sector, which of course includes GameStop.
So if the retail sector has a good day, up 1%, RETL should theoretically be up 3%.
That's the idea. Of course, what goes up.
Must come down.
Exactly. And because RTL is 3 times leveraged, even small moves in the underlying stocks, especially something as volatile as GameStop, it can create massive swings in buying and selling pressure as the ETF tries to keep everything balanced. It's a recipe for volatility.
So let's play this out. Let's say you have a hedge fund and they've got a big short position in GameStop. Now they're looking to, I don't know, create a little short squeeze, maybe push some retail investors out or trigger some stop-loss orders. Could they use RTL for that?
It's definitely possible. Because of that 3 times leverage, even a relatively small strategic buy order could have a huge impact on RTL. That could force the ETF to buy more GameStop, creating this temporary price surge. They wouldn't have to move the entire market, just push GameStop just enough.
It's almost like using leverage as a weapon.
Well, that's one way to look at it. But it highlights why you have to be careful with leveraged ETFs. They're really designed for short-term plays, and their price movements can be, well, let's just say, exciting.
Okay, so we've got XRT with its vulnerabilities around rebalancing, VB and IWM, which can be susceptible to large-scale maneuvers due to their size and liquidity. And then there's RETL, a potential tool for amplifying volatility. What else is on our list?
One more, RZV. The Invesco S&P Small Cap 600 Pure Value ETF.
RZV. Haven't heard of that one.
It's not as big as IWM or VB, but it's got its own quirks. You see, it focuses specifically on small cap value stocks, many of which aren't as widely traded, and that can make it a target.
Because it's smaller, it's easier to move the needle.
In a nutshell, a relatively small investment could be enough to shift the price, creating that arbitrage opportunity that someone could then use to their advantage. It's like finding an overlooked corner of the market where it might be easier to, well, make a splash.
So we've gone deep really deep into this world of ETFs. We've talked about how they can be manipulated, how specific ETFs might be more vulnerable than others. But let's bring this home for our listeners, the expert investors. What are the real-world implications here?
Well, the biggest takeaway here is not to shy away from ETFs. Don't let this scare you. They're still incredibly valuable tools for any investor. But, and this is a big but, the GameStop situation, it's a wake-up call, a reminder that even the smartest, most seasoned investors, we can all be caught off guard. It's a reminder to really understand how ETFs work, to be aware of those little quirks and vulnerabilities that maybe we haven't paid enough attention to.
It's not about avoiding ETFs altogether. It's about being informed, being discerning, understanding that an ETF, it's not just a static basket of stocks. It's dynamic with its own set of rules and, yeah, even its own potential risks.
Absolutely. Don't get me wrong. Past performance is important, and the ETF's stated objectives, those matter too. But go a layer deeper. Ask the questions that most people don't even think to ask. Who are the APs for this ETF? What's their track record? Are there any, well, let's call them irregularities in the ETF's trading patterns? These questions, they can be really revealing.
It's like the difference between, I don't know, just looking at a map and actually understanding the terrain. Both are useful, but one, it gives you a much deeper appreciation for what you're getting into.
Great analogy. And this kind of thinking, it's not just about managing your own risk. It can actually create opportunities. Think about it. If you can spot an ETF whose price is out of whack, not because of the fundamentals, but because of these manipulations we've been talking about, well, that's an opportunity.
Right. It's like having this secret decoder ring, this ability to cut through the noise and make smarter decisions.
Exactly. And, just as important as all of that, maybe even more so, this knowledge, it empowers you. It makes you a more informed investor, someone who can start asking the tough questions, questions about transparency, about regulation. The more we understand, the harder it is for these kinds of things to happen right under our noses.
It's true. Like they say, sunlight is the best disinfectant.
Couldn't agree more. And on that note, I'd encourage everyone listening to really dig in. GameStop, it's just one example. The tactics, the vulnerabilities we talked about today, they're out there. So be curious, keep learning, and don't underestimate the complexity of this market.
Well said. Thanks for joining us for this deep dive, everyone. It's been, well, illuminating, to say the least. And remember, knowledge is power. So until next time, keep asking the tough questions and, as always, invest wisely.